Okay, hello again. Let's do some short remarks now on corporation tax in Germany. And so let's talk about the simple basics. First, who pays corporation tax? Naturally, you know that already from a chart some sections ago, that us juridical persons. So in Germany, corporation tax covers all juridical persons, even those outside the country, if they receive revenue from inside Germany. So we have here again limited and unlimited tax liability if a corporation is based in Germany, either with the registered office, so with the so-called statutory seat, or with the place of management. Then it's taxed on the basis of the worldwide income under the headline unlimited tax liability. If it's neither nor, so if it's outside Germany, then it's only taxed with the income from the inland under the rules of limited tax liability. The tax base is defined as in the Income Tax Act, but with slight modifications. For example, certain deductions which take into account that natural persons need certain financial means for survival or so. These personal allowances are naturally not granted to corporations, and some other modifications can be found. There is even a simplification rule because although in principle the rule says the income of corporations or juridical persons is determined according to the same rules as under income tax law. So in principle, they can have 7 types of income. For certain corporations, there is a simplified approach that everything they have is automatically classified as income from business. That usually goes back to historical times, because originally under German law, certain corporations could only be established with the aim to run a business, and so the fiscal administration originally probably said they can only have, under their statutes, income from business. They are not allowed to do anything else, so everything they have must be income from business. Later that was liberalized, but then naturally that tradition was conserved into tax law. Everything what a GmbH or AG or SE does is automatically classified as income from business, irrespective of where the money really comes from. The tax rate is another surprise. You remember it's going from 0 to 45% for natural persons. The corporation tax rate is in opposition to that, only 15%. So rather low. The explanation for that surprising tax rate is that once a corporation pays out its profits to its shareholders, so to its owners, then these shareholders will again be taxed on these dividends. So in the course of time, there will be 2 taxes. First, corporation tax on the profit on the level of the corporation, and later income tax on the dividend on the level of the shareholders. And because of these 2 subsequent steps of taxation, the total amount of tax must not become too high, and that's a reason for reduced rates at both levels. Corporation tax is fixed at 15%, and dividends are usually taxed with 25% or something like that. So the idea is that for the average shareholder, you end up with a tax burden of some 40%. That's only half of the truth, because trade tax will come on top. And so in real life, the total tax burden on the profit of a corporation during the total course of time will rather be more or a bit more than 50% of the profit. So that sounds surprisingly low, but in reality it's adequate. Peculiar aspects: if you have a group of companies, so a parent and a subsidiary, then the subsidiary is naturally taxed on its profit when it pays out the dividend then to its parent. This is in principle again income for the parent company, but we know that later on the shareholder level, income tax will still come on top, and so to avoid a triple taxation, very often dividends which a corporation gets from another corporation are tax-free in its hand, so in the hand of the recipient, because it has already been taxed. But very often states deviate from that logic when the participation of the parent company is only relatively low. So if it's a mere capital investment without entrepreneurial influence, they very often are keen on the money too, so they don't renounce on the dividend tax there. So many states, especially Germany too, take corporation tax on dividend, which a corporation gets from another corporation, if not a certain minimum percentage of holding of participation is met. Here, that would be 10% or more. That guarantees you as a parent company that your dividend revenue is tax-free. If it's less, let's say only 9.9% participation, then the dividend from the investment will be still taxable. Other countries very often have similar approaches, as I already mentioned. A very important thing is when it comes to tax planning or to the evaluation of the tax situation of a company and its shareholders, that a corporation can make contracts which are acknowledged under tax law for and with its shareholders. The only requirement is that such a contract must be carried through under conditions which are conform to the market conditions. So the usual test is, would a responsible and careful manager of that corporation have agreed to such a contract under the same conditions if it had not been with a shareholder or on the wish of a shareholder. So the approach is, would they have concluded that identical contract also with an unrelated outsider, so-called third person? This is also called the so-called oh my god, it's late. So this is also called the so-called dealing at arm's length approach, because friends, you can be friends when you negotiate with a business partner, but you always keep a certain minimum distance for and with people who are not close as friends and family, and that is usually the length of one arm. You can really observe that in real life. There is a certain minimum distance which even friends keep, and the idea is, this is the model for negotiations between unrelated business partners. Can be friends, but there should be still the distance which is customary for business friends, so not for spouses and children, and that is arm's length principle. So it has nothing to do with being in arms. Yeah. Now, if a check shows that payments exceed the adequate amounts, then only the adequate amounts are recognized as payment under the contract. The rest would be qualified as a hidden dividend if the company pays more money than necessary or adequate to the shareholder for the contract, or if the shareholder gives too much money to the corporation, then only the adequate amount would be regarded as adequate remuneration in connection with the contract, and the rest would be classified as a hidden contribution, because naturally, if the shareholder gives something to its corporation without getting anything in return, this is a contribution, And if you hide it under the cover of a contract, then it's still a contribution. So the decisive thing is here contracts are acknowledged, accepted, but they are checked for conformity with the market conditions under the arm's length principle, and deviations will be split off and then classified as either a hidden dividend or a hidden capital contribution. But the adequate amounts can be accepted. So, for example, if you are the shareholder of a GmbH, you are the 100% shareholder, you have two choices. You can either do the management for free for the corporation, then you don't have any wage income, and the corporation doesn't have any expense. So everything will end up as profit of the GmbH and will be taxed there with trade tax and corporation tax. The other alternative is you could say, I make an employment contract with my own GmbH because we are two persons. I am now doing management as an employee of my GmbH. It pays me a wage. And as this wage contract will be accepted by tax law, that will mean the business profit of the GmbH goes down by my wage. So for example, if it's 50,000 a year, then they have a business expense of 50,000, which lowers their tax base. And my tax base goes up by these 50,000, which I now have to subject to my income tax as income from employment because I was an employee and was paid for that. You can also do that with in other examples. For example, if a shareholder buy a house from his own GmbH for 100,000, then the house has a book value of 50,000 and a market value of 700,000. Then you always demand, under the perspective of tax law, that the sale of the house is done for market conform conditions. So they will treat it as if it had been sold for 700,000. And if now the GmbH renounces on 600,000 of that money because they only claim 100,000, that would be they hand the shareholder back 600,000 of the market conform remuneration, and handing money back to a shareholder without any proper reason, that is simply a dividend. So that would be construed as a hidden profit distribution or hidden dividend. Yeah, if you compare that with the situation of natural persons or partnerships, you see one fundamental difference. Contracts between a natural person or a partnership are not acknowledged by tax law. Contracts between a sole trader and his firm are not even possible under civil law. Why? Well, the contracts can only be made by persons, and the owner and his or her firm. Well, the firm is an object. It cannot make contracts. Only the owner of the firm could make a contract, and the owner of the firm is the owner. So the owner can't make a contract with the owner because you can't make a contract within one person. You can't take obligations on yourself and sue yourself and bring yourself to court, claim that you force yourself to pay. Makes no sense. Contracts require two parties which enter into contract, and these do not exist here. A similar situation do we have if you have partnership in play, because at least German law says if a partnership and a partner make a contract, at least on services, the great exception is, I believe, selling objects. But if there is a contract on services, it will not be acknowledged by tax law. It will be completely ignored. And what that partner gets for, let's say, management services, for giving a loan, for letting a house for rent or so. All these things will be classified as just an additional part of the profit paid out to that partner. So the contracts between a partnership and one of the partners are usually under German law not accepted at all. They do not bring along a business expense, and they do not lead to rent income, employment income, or so on on the side of the partner. So that makes a difference. They remain income from business. So, for example, if we have a partner of a partnership who decides to let an office building for rent to that partnership, and then they say that the monthly rent payment is 40,000 instead of an adequate 30,000. In case of a GmbH, that deviation from the market price would pose problems, and one would debate about that 10,000 in excess, which were paid too much. Then these are hidden dividend and so on. All these problems do not exist in case of a partnership, because the contract with the partnership and the partner is, from the perspective of tax law, completely ignored. The whole payment does not exist. That is not accepted as a business expense of the partnership, and if there is no business expense, nobody cares about how high it should have been. So it does not matter if it is 30,000 and not accepted or 40,000 and not accepted. It's simply not accepted. Afterwards, one just finds out that that partner had the right to take out 40,000 as his additional share of the profit from the partnership. So these 40,000 will be taxed in his or her hand as 40,000 income from business, in addition to his other shares in the profit. So completely different. Had that been a GmbH, the 30,000, which were adequate, would have been recognized as business expense of the GmbH and would have been taxed under the rules of lease and rent income in the hand of the partner. That could have triggered different treatment, and it would definitely have led to different tax rates, because the tax base of the GmbH would have gone down and the tax base of our natural person, the shareholder, would have gone up. And there the tax rate is either 15% or 40 or a maximum 45. So there it would have made a difference for the total tax burden of the two persons involved, of the company and the shareholder. Here, in case of a partnership, that doesn't happen. So keep in mind, depending on the legal form of an enterprise, the tax treatment and the tax consequences of a contract between the firm and one or all of its owners are entirely different. So choosing the legal form also decides about, can you make contracts with effect for taxation or not? So that naturally can enable you, if you opt for a corporation, to do a certain fine-tuning of your personal situation. Imagine, for example, a manager's salary, which you could claim is 200,000. Now, 200,000 taxed under corporation tax is relatively cheap, let's say 30%. In the hand of a natural person, this would probably be higher. So if the GmbH is my owner, I would probably not pay to myself a salary of 200,000, because in my hands as employment income, the tax burden would probably be higher than if I work for free for the GmbH, might be. Now, on the other hand, imagine I have a spouse and 10 children, so I get many personal allowances. one for myself, approximately 10,000, one for my spouse, approximately 10,000, and approximately 5,000 for each child, then I could earn up to 7,000 euro tax-free during a year without paying a single euro of tax. Well, naturally, then I would try to make an employment contract with my own firm, because then I could at least lower the corporation tax profit by these 70,000, and in my hands they would be subject to income tax as income from employment, but surprise, due to all my personal allowances, the taxable income would still be zero. So naturally, a tax advisor would recommend that in such a situation. At least if you once decided for the GmbH, GmbH have no personal allowances, but then probably your tax advisor would say, at least to do some fine-tuning, take great care that at least you get paid from your corporation from some services which you really and effectuate, which you really do, that you get paid with the market price, which leads in your hand to a small income so that you can make use of your personal allowances. That lowers the total tax burden of both. And so would be an idea. That brings us to the aspect that the choice of the legal form for an enterprise is really a big entrepreneurial idea and decision, which you have to thoroughly plan, and there you have to take the tax consequences into account and prognosticate them. So you must have an idea of how much profit you will make in the long run. For example, if you always expect that you will have a profit of 20,000 or 30,000 annually, then you will probably always end up with a very low income tax. Whereas if you then incorporate your business in form of a GmbH, then the GmbH will pay 15% corporation tax, approximately 15% on top trade tax. And then later the dividend will again be taxed with 25% on the remaining 70% which are left over. So you get a total tax burden of approximately 50%. Far too high compared with what you would pay if you run the business as a sole trader and earn 20 or 30,000, because then you get off with an average tax burden of less than 20% probably. So in that case, it would be preferable to have a sole tradership or a KG or some partnership form where you pay income tax. On the other hand, when you expect 100 million euro profit, then it's clear as a natural person you would pay enormous tax rates, 45% at least. Now, if you don't intend to consume all that money, but you want to let it in the firm for later, then you might get off, instead of 45%, with 15% corporation tax, trade tax, so with 30%, and well, the remaining 25% on the dividend will arise in 20 years, 100 years, 200 years, whenever you or your heirs take off money from the firm. Perhaps that never happens. So in that case, a tax advisor and you would probably say we prefer the GmbH because it allows us to keep more net profit for a very long time, instead of wasting too much money under income tax law. So as you saw already from my example, it is probably negative if you do the 100 million euro, form a corporation, and then directly have the money paid out in form of a dividend. Because then, ladies and gentlemen, you would pay the 30% immediately, and immediately also the 25% on the dividend, which remains. And so you come close to 50% instead of only 45%, which you would have paid if you do not incorporate but run a partnership. So planning makes sense there. So it depends on the individual circumstances. And then I already mentioned, yes, is a fine-tuning of the situation recommendable? And the answer is yes. For example, in case of a corporation, the owner will have some personal allowances. There will be some bracket which has a low tax rate, and the owner will probably make use of that. The money which you are going to consume, you don't need that in form of dividends, because dividends leave the GmbH at a tax level combined corporation and income tax and freight tax of approximately 50%. So making an employment contract and getting 20 or 30,000 as an annual salary, which are then only taxed as income from employment in your hands and leaves the GmbH untaxed in form of a business expense, well, that is probably more favorable, and that is what really every tax advisor will recommend to you. Naturally, in case of a sole tradership or a partnership, that option to do some fine tuning under or by the use of contracts doesn't exist for tax. Okay, this is again one nice small chapter. Another one is going to come on the basic rules of trade tax, but now we should again have a small break and look for later. Thanks for watching. Till the next time.